Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Counsel. It's Wednesday, June 26th. Welcome to our Global Markets Commentary. In this month's segment, we digest the year thus far and update our forecasts for the remainder of 2024 and beyond. The first half of 2024 has delivered solid equity market results. Bond yields have been volatile, but Canadian bond markets are on track to post a small year-to-date gain. Thus far, the typical, well-diversified Canadian balanced investor enjoys a total return in the range of 7% year-to-date. The global macroeconomic backdrop is in decent shape, especially considering where we've come from: high inflation and sluggish global growth. As always, there are some mixed signals, but more signs point to a soft landing than to anything else. This is the outcome aligned with our base case and that everyone generally hoped for. The Goldilocks scenario: not too hot, not too cold, economic growth that allows COVID disruptions to settle, demand and supply to realign, and inflation to fall back into an acceptable range. Given the friendly macroeconomic backdrop, major global equity markets are buoyant on the year, with most up mid to high single digits. The S&P 500 and NASDAQ top the list and are raising eyebrows again, as the gains are concentrated in a handful of stocks where valuations aren't cheap. We see this as a glass half full scenario. History shows that once the outperformance of the mega cap settles down, the broader market can do just fine. Herein lies the opportunity. A few stocks have surged ahead, making them quite expensive, but in their wake lies a vast swath of stocks with more attractive valuations. Simply because some US-based global multinationals have powered ahead doesn't mean that other markets can't perform. We see a fertile environment for risk assets, stable to recovering economies, the worst of inflation is likely behind us, and easing monetary policy is either upon us now or likely to begin soon. Outside the US, there are signs economic growth is picking up, while inflation is moderating. 11 of the G20 countries have inflation below 3%. In fact, more than half of the 130 countries tracked by Bloomberg have inflation that starts with a 2. Global manufacturing is trying to bottom and turn higher, and housing activity is bottoming. However, housing likely needs rate relief to pick up steam. Rate relief, we believe, is coming. Consumers are slowing down a bit, but wage growth and employment keep the outlook constructive. Moving forward, these green shoots in the global economy should be nurtured by the clear pivot by most non-US central banks pivoting toward cutting interest rates. With its June quarter-point rate cut, the Bank of Canada is among the vanguard here. While the most recent Canadian inflation reading was a bit disappointing, we still see the Bank of Canada adding 2 more quarter-point cuts in September and December. The story in the U.S. is more mixed, but still constructive. Given the still strong U.S. economy, the U.S. Federal Reserve remains reluctant to begin a rate-cutting cycle. With some cracks appearing in consumer spending and employment, we believe U.S. economic activity will cool enough and inflation will continue to fall enough that the Fed will cut by a quarter point in September and December. So, what's our outlook for the rest of the year? Revisiting our base case, which we've held since publishing our 2024 outlook back in December, at the end of the year, cash should yield in the low 4% range. That's no change from our December view. We called for a 6% return from the bond market for the year. The FTSE Canada Universe Bond Index is up about 0.5% for the year, but June alone saw a 2% gain. We still see 3 to 4% in the back half of 2024 as possible. A little lighter than the original forecast, but still decent. For equity markets, our total return estimates for 2024, again published back in December, called for 10 to 12% in Canadian equities. We've booked 4 so far, so 6 to 8 to go. We're still comfortable with that, but to get all of that return, we need to see the Fed cutting rates so the Bank of Canada can continue to lean toward rate cuts as well. For the S&P 500, most analysts' forecasts from December have hit the trash bin. we started at 4,900 and we were among the more bullish. That was up to 5,100 in January and again to 5,400 in March. And we continue to hold that view now. But our more bullish scenario can easily get us to 5,700, and we think we'll be looking at 6,000 for the S&P 500 in 2025. Line up all three major asset classes, cash, bonds, and stocks, at 4%, 6%, and 10% returns, looking out to 2025. It is a great time to be an investor, especially a balanced one. That's the way we saw the first half of 2024 and our forecasts for the end of the year. Thank you for joining us.